Hey everyone, welcome back to Corporate Decoder, the place where we decode what corporations are really up to. And today we have a filing from Art Technology Acquisition Corp, a company looking to make a splash in the market, but with a twist that you will definitely want to hear about. This is a bit of a unique situation for us because Art Technology Acquisition Corp is essentially a blank check company. Think of it as a company with a pile of money looking for a business to buy and merge with, essentially to take that business public. They are not selling oil or software right now, they are selling the idea of a future business combination. So what are they selling and why should you care? They are offering units of their company for $10 a unit. Each unit is made up of one Class A ordinary share and a fraction of a warrant. Warrants are like options. They give you the right to buy shares later at a set price. They are hoping to raise a cool $220 million from this offering. Now here is where it gets interesting. They are incorporated in the Cayman Islands, a popular spot for these kinds of companies. Their whole game plan is to find a company likely in the technology, art, or financial services sector and merge with it. They haven't even picked a target yet, so investors are essentially betting on the management team's ability to find a good deal. Let us talk about the sponsors. They bought 8.7 million shares of Class B stock for just $25,000. Talk about a deal. This is a classic SPAC move where insiders get shares at a nominal price. This is a big point of dilution and a potential profit center for them. If the company succeeds and merges, they could make a substantial profit, while public shareholders might see their investment value decrease from the get-go. For regulatory purposes, this company is considered an emerging growth company and a smaller reporting company. This means they have fewer reporting requirements, which can be good for them, saving on costs, but maybe less transparency for investors. Now for the numbers, looking at their dilution table, as expected, buying these units at $10 means your initial net tangible book value per S-share is significantly less. For example, without any redemptions and the over-allotment option not exercised, your net tangible book value per S-share could be around $7.03, meaning you are paying almost $3 more per share than its tangible book value. This dilution is mainly due to those cheap founder shares. What happens if they don't find a good business combination? They have to give the money back. The money raised from the public offering goes into a trust account, and if they don't complete a deal within 24 months or 27 months, if they have a deal but not closed it, then they have to return the money to shareholders. Shareholders can also redeem their shares if they don't like the proposed business combination. Right now, there is no public market for their units, shares, or warrants. They are hoping to get listed on the NASDAQ, which is a big step. If they don't get listed, NASDAQ approval is a condition for closing this offering. Now let's dive into the risks, and there are many. They highlight a lot of risks for investors. One major risk is that your vote on the business combination might not even matter if they choose to use a tender offer instead of a shareholder vote. Also, if too many shareholders decide to redeem their shares, it could mess up the deal or make the company unattractive to potential acquisition targets. Remember those founder shares? The sponsor and management team have agreed to vote their shares in favor of an initial business combination. Combined with their share ownership, this makes it very likely that any deal they propose will get approved even by a majority of public shareholders. This is a significant conflict of interest. They stand to profit greatly from a deal closing, even if it's not a great deal for you. Looking at their balance sheet for the 30th of September 2025, they have a working capital deficiency of nearly $70,000, and their total assets are just over $55,000. This is a company that has barely started and is reliant on this offering to even begin operations. The as-adjusted numbers show what happens after the offering, indicating a significant increase in assets due to the cash infusion, but also significant liabilities like deferred underwriting commissions. Their financial discussion is pretty straightforward since they have no operations yet. Their liquidity depends entirely on this offering. After expenses, they expect to have about $3.1 million outside the trust account for operations. They will also pay their sponsor $30,000 a month for office space and support. The balance sheet from the 10th of September 2025 shows very little activity pre-offering, with just $10,000 in prepaid expenses and $34,400 in total assets. Their shareholder deficit is stark, highlighting that their liabilities exceed their assets. The statement of operations shows that all their so-called expenses are formation and administrative costs. They literally have a net loss of over $48,000 for the period ending the 30th of September 2025 with zero revenue. This is typical for a SPAC before it finds a target. They are an emerging growth company and are taking advantage of relaxed reporting rules. This could make their financials harder to compare to other companies and less attractive to some investors. They also state the preparation of financial statements relies on management estimates, which means actual results could differ. The related party transaction section is crucial. The sponsor bought founder shares for a tiny fraction of a cent, per S-Hair and has committed to buying more units. This again points to the significant personal profit potential for insiders, which as we've mentioned can create conflicts of interest. They are also repaying loans from the sponsor and paying monthly fees for services to the sponsor and executives. After this offering, around 30 million shares will be outstanding. Roughly 7.6 million of those are founder shares held by the sponsor and other insiders. These founder shares have transfer restrictions for a year after a business combination or until the stock price hits certain targets. This is a tax thing to be aware of because they are a Cayman Islands company with no business operations. They are likely to be considered a passive foreign investment company, or PFIC. If you are a US investor, this can lead to complicated and unfavorable tax consequences if you don't make certain elections. It is a big warning sign for us investors. Clear Street LLC is the sole book running manager. They are underwriting this offering and will receive a significant chunk of the money as commissions. Some of those commissions are deferred. If the company doesn't find a business combination, the underwriters forfeit their deferred commissions. They have an over-allotment option, allowing the underwriters to buy up to 3.3 million more units if demand is high. They also have a lock-up period for the sponsor executives and directors for 180 days after the offering, meaning they can't sell their shares immediately. This is a legal point but important for investors. They've set up their company so that legal disputes with shareholders generally have to be handled in the Cayman Islands, not in the US. This can make it much harder and more expensive for shareholders to pursue legal action. The auditor's report flags a major concern. The company has substantial doubt about its ability to continue as a going concern. This is because they have no operations, no revenue, and need this IPO to even fund their search for a business. It is a very standard SPAC doc, but the heading itself is a red flag. So what is the big picture here? Our Technology Acquisition Corp is a typical SPAC looking to raise capital to acquire a business. The main story is the inherent conflict of interest from the insider shares bought at a nominal price, the potential for significant dilution, and the tax implications for us investors if they end up being a PFIC. Their path to being a public company hinges entirely on finding and successfully merging with a suitable business within their limited time frame. The risks are substantial, and investors are betting heavily on the management team's ability to navigate these waters. What is your take on this SPAC and its prospects? Do you think the management team can deliver a good acquisition, or are the risks too high? Let us know your thoughts in the comments below. If you found this deep dive useful, give us a thumbs up and subscribe for more corporate decoding. And don't forget to join our Discord community linked in the description for more discussions like this. Thanks for watching, and we'll see you next time.